Good morning, everyone. I hope you're all well. This week, we have moved on to a very different conversation, one that sounds like a huge injustice. Imagine paying income tax on money you never actually received. It sounds impossible. It isn't. Not money you spent, not money you're choosing to reinvest, money that in cash terms simply isn't there, and yet it's sitting on your tax return as income, taxed at your full rate. That's the reality for a huge number of landlords in the UK, including plenty of people earning well into six figures who've done everything else right and have no idea this is happening to them. If you're a higher earner thinking about buying a second property, a buy-to-let, somewhere for a family member, anywhere that isn't your main home, there's a rule sitting underneath that decision that most people don't discover until they're already a year or two in. By then, the only thing left to do is live with it. I'm Mark, and let's work through it together. So here's exactly how that's possible. If you've got a mortgage on a rental property, you might assume, reasonably, that you pay tax on your rental profit, meaning rent minus mortgage interest minus other costs. That's how it used to work, and it's how most people instinctively think about it. It's not how it works anymore. Since the rules changed, fully in place since the 2020-21 tax year, mortgage interest on residential rental property is no longer deducted from your rental income before tax is calculated. Instead, your full rental income, with no deduction for mortgage interest, is added to your other income for tax purposes. Then, separately, you get a tax credit worth 20% of the mortgage interest you paid. Here's why that matters at higher rates. If you're a 45% taxpayer, you're taxed on the full rental income at 45%. Then you get relief on the interest at only 20%. The gap, that 25 percentage points, is effectively extra tax on money that went straight to your mortgage lender, not to you. But there's a second effect that's even more important for this audience, and it's the one almost nobody mentions. Your adjusted net income, the figure that determines whether you're in the personal allowance taper or whether you're over the child benefit threshold, is based on that full rental income before the interest credit is applied. So a property that's barely breaking even in cash terms, once you've actually paid the mortgage, can still add £10,000 or £15,000 to your adjusted net income on paper. That's enough, on its own, to push someone from just under £100,000 into the 60% taper band, or to trigger the child benefit charge, even though the actual cash profit might be a few £100s a month. That's the money you never earned, sitting on your tax return as if you did. Now let's rewind to the very beginning, because there's a cost at the purchase stage that often gets underestimated too, and it compounds everything I've just described. In England, buying an additional residential property, one that isn't replacing your main home, attracts a stamp duty surcharge on top of the normal rates. That surcharge currently sits at 5%, and it applies to the entire purchase price, from the first pound, on top of whatever the standard stamp duty would have been anyway. So, if you're buying a £400,000 second property, the standard stamp duty might be somewhere around £10,000 to £12,000. The 5% surcharge adds another £20,000 on top, regardless of which band the property falls into. That's money gone the day you complete, before the property has done anything for you at all, and before the income tax issue I just described has even started. There's one more wrinkle worth knowing about if the property you're considering is a holiday let rather than a standard rental. Up until April 2025, furnished holiday lettings had their own, more favourable tax regime. Full mortgage interest deductibility, capital allowances on furnishings, and the ability to count the income as relevant earnings for pension purposes. That regime has now been abolished. Furnished holiday lets are taxed the same way as any other residential rental, which means the interest restriction I just described applies to them too. If you've seen holiday let investment content that talks about these advantages, it's likely describing rules that no longer exist. Let me bring this together with someone real. Daniel, higher rate taxpayer, salary around 95,000. He buys a £400,000 buy-to-let with a £300,000 mortgage, expecting around £18,000 a year in rent. On the surface, that's a healthy yield. Cost 1. On day 1, the stamp duty surcharge takes £20,000. Cost 2. Once it's let out, the £18,000 in rent is added in full to Daniel's income for tax purposes, pushing his adjusted net income from £95,000 to over £113,000. He's now in the personal allowance taper. Roughly £13,000 of his income is now taxed in the 60% effective band, purely because of how the rental income is counted before his mortgage interest is taken into account. He gets a 20% credit on his mortgage interest, say £6,000 of interest, so £1,200 back. But he's lost several £1,000s to the taper that he never saw coming. That's £13,000 of phantom income, money that never reached his bank account, taxed as if it had. Cost 3. 3 years later, he sells. The property's gone up by £60,000. After costs, his gain is taxed at 24%, over £14,000, and he has 60 days from completion to report and pay it, which he discovers only when his accountant mentions it after the sale's already gone through. Add it up, and across the purchase, 3 years of holding, and the sale, Daniel's tax position on this property runs to tens of thousands of pounds beyond what the rent and mortgage numbers ever suggested. None of this means the property was a bad decision. It might still have made sense. But Daniel priced the rent and the mortgage. He didn't price the stamp duty surcharge, the effect on his adjusted net income, or the 60-day CGT deadline. And all three were entirely predictable before he ever made an offer. The tax treatment of a second property at this income level isn't a footnote to the investment decision. It's a core part of it, arguably as important as the yield itself, because it changes what the yield actually means to you. Most of the content people consume about property investing is written for or by people for whom none of this applies in the same way. The stamp duty surcharge, the phantom income effect on your adjusted net income, the 60-day CGT window. None of it shows up in a typical yield calculation, but all of it shows up in your tax return. And the money you never earned isn't a turn of phrase. For tax purposes, it's treated as if you did. If you're considering a second property, 3 things to do before you commit. 1. Factor the stamp duty surcharge into your upfront costs as a real number, not an afterthought. At 5% of the purchase price, it changes the maths from day 1. 2. Calculate what the full rental income, not the profit after mortgage interest, does to your adjusted net income. If it tips you into the taper or the child benefit charge, that's a cost of the property too, even if you never see that money. This is the calculation almost nobody does before buying, and it's the one that matters most. 3. Know the 60-day reporting deadline for capital gains tax on disposal exists, well before you ever plan to sell. It's much easier to plan for a known deadline than to discover one. I hope you found our chat useful today. If you've got a question, or there's something you'd like me to cover in a future video, leave a comment below. I'll do my best to help. If you found this useful, I'd really appreciate you subscribing. In the next video, we're looking at the other end of the spectrum. What to do when a large amount of money arrives all at once, in the form of a bonus. 2 colleagues, same bonus, same week, and one of them ends up with almost double the other. The instinct is to treat it like income. The structured approach treats it completely differently. Until next time, take care.